Martin here from Financial Trip, and today I want to talk to you about our investment philosophy, or my investment philosophy when it comes to investing your money in retirement. And it's rather simple. It's about aligning the right investments for your needs. Sounds simple, a bit more complex with that. But what I mean, in a general sense, there's three kinds of investments broadly. Cash, which comes in various forms, property, which comes in various forms, and shares, which come in various forms. In an ideal world, we want a bit of everything. Depending on the amount of money we've got to invest, is for how we figure out how to spread that across those different investments. Which is the best one? Should we have it all in one? No, definitely not. We ideally want to have a spread amongst all of them. Why? Each of those different assets moves in a different fashion. They've got different things going on. Cash is safe, it's secure, it's never going to grow. And in retirement, we need something that's growing and meeting inflation, but also it's not going to go down. We know there'll be some shocks in the markets, in the world, in the economy. We want to have some certainty. And that's what cash gives us that. It gives us liquidity. We can have a certain amount, we can access, we pay our pension from it. So we definitely have a certain amount of cash, but we don't want it all in cash. I use what's called a bucket philosophy, and I'll come back to that in a sec. But cash is the key role in that. Cash might be cash in the bank, might be a term deposit, might be a fixed interest bond style of investment, but all that kind of comes into cash. Property has a role to play. If we have enough investments, you already own some property, I love to have property in retirement. It gives us some income along the way, which is fairly certain and secure. It's not always too high, it might only be about 3%, but it's coming in every week. It gives us some inflation. If the markets keep going up, the world keeps going up, property typically moves up along the same time, which is great. It plays a certain role. The problem is it's expensive. We can't just go buy $50,000 worth of residential property. We can in some shares, we can get access to some other kind of property, but in this property, I'm really talking about a rental property down the street or something like that. What we don't want to have is all of your money in property, or really more than 70 or 80%. I ideally say we want no more than 50% of your total investment assets in property. To make it easy, if we had $1 million, we don't want more than 500,000 in property. Just because the downside of property is it's illiquid, which means that it's harder to sell. We can't sell just a little bit of it. We either own the whole property or we own none. And what I've found when I've done the numbers is we can retire, even if we had a couple $100,000 in cash, a couple $100,000 in shares and some property, well, that'll get us by for a while, but at some point they're going to go down and we're going to have to sell that property. And that's okay, but the way to protect it is to keep it no more than 50%. So we're looking at $5 million, perfect. We can have a couple of rental properties easy, plus other stuff going on. But if your investment pool is lower, well, it's tough to own some property in there. Let's figure out if we can make it work, but understand that I definitely have some limits on that because we know we're going to have to sell that property. What we don't want to do is have to sell it at a time, which is not right. I.e., we get 3 years into retirement, we have to sell the property because you need some extra cash. We can't, or it's a bad time in the markets to sell it, and we're a little bit stuck. The other asset we're definitely going to look at is shares. Why? There's definitely pros and cons with shares. The markets certainly go up, they go down. There's risk involved with shares, but as long as we plan it the right way, we can reduce that risk. Like property, shares has growth. It will grow. Companies make profits, they reinvest, they'll grow more next year. So over time, we'll expect shares to go up. Shares typically provide a pretty good income. 4, maybe 5%, either including or plus what's called some franking credits, which are really good in retirement. I talked about that in another video. But they give us a good certain level of income each year. If we can have enough in your shares or your property, that income alone should be able to support your pension, which would be ideal. We'll figure that out when we jump into the detail. We definitely want some allocation to shares, property, and cash. Let me quickly talk about our bucket approach. There's different ways to operate this. This is the way that I've found it works best for me and my clients, and we've used this for years and years to make sure we get the best result for you. So what that looks like is we have an allocation to what I call growth, and that includes the shares and the property together. We want to have allocation to growth. How much we allocate to depends on your circumstances and how much you're taking out, and involves around the cash bit. Because what I want to do is make sure typically, and I'll personalize it when I talk to you, but typically you want to have about 5 years worth of living cost or pension payments in cash. So if you want to live off $100,000 a year, we'll have $500,000 in cash. We won't have it all just sitting in a bank account. Some will be in some term deposits or fixed interest, some other kind of investments that are still earning you something, but we'll have access to, and ideally keep topping up and managing it, about 5 years worth of cash. What that allows us to do is that it allows us to take control of the shares in the property and decide ourselves when is the right time to sell it. I've seen a lot of people set up retirement, put it all in one big, mix it all up together, take a regular amount out, and they end up selling some shares and property every single month. And all of a sudden they're doing it in the wrong time in the market, they're selling at the bottom, all that kind of stuff. We want to separate that. We want to take that risk away. And we want to have clearly distinctive buckets between cash and growth assets. And I use what's called a bit of a buffer bucket. I'm sure I've already talked to you about it, or we'll definitely want to do it when we next catch up. So that's how we want to do that. We want to have a certain amount in cash, some access available to use right now, some in some kind of fix or investment that's getting us a bit more, but have that completely separate to the shares and property. What that means, and we've seen it in the recent market movements, when the market goes down, we don't have to sell. We know we've got 5 years set aside. It gives us the patience, the time, the confidence to know that the market will go back up. And then when it's the right time, that's when we'll take some cash out of the market if we need to. Going back to my same property discussion, it means that we've got at least 5 years to sell that property. Ideally longer, but we've got time on our side. We're not going to be dictated to what the property market looks like in 2 years' time. We'll be able to plan for it properly, decide when's the right time for tax, investment cycles, all that kind of stuff, to liquidate and sell either some properties or shares along the way. So that's kind of the investment philosophy we use here at Financial Edge Group. Things might change. I try and keep costs as low as possible, transparency, using some direct stocks or direct allocations, etc., to basically save you fees, more money in your pocket, but also give you that transparent, the confidence you can see exactly what you're invested in. It's not this big mixed up bucket, you're not really sure what's going on. It's in the growth fund. What exactly does that mean? We want to make sure we know exactly what our super is doing or our investments are doing to give you that confidence. Hopefully that makes sense. I'm sure a lot of this stuff I've mentioned to you, I will mention to you. I just wanted to summarize in a quick little video for you to have a check out, and we can have a chat about it more when we catch up.